In the last video, we talked about the three forces that drain your salary before you even begin: taxation, inflation, and lifestyle inflation. And at the end, we made you a promise. We said we would take you inside the exact trap banks set for you, the one built into the system, the one most people never see until it is already too late. Today, we keep that promise. Here is something almost nobody tells you. Banks are not in the business of lending you money. They are in the business of keeping you in debt. There is a profound difference between those two things, and understanding that difference is worth more to your financial future than any raise, any bonus, or any side hustle you will ever find. By the end of this video, you will understand exactly how the debt trap works, why it is so effective, and the precise steps to dismantle it. Stay with us. Number 1. How banks actually make money. Let's start with what banks actually are. Most people think of a bank as a place that keeps money safe, a vault, a guardian, an institution on your side. And in a narrow sense, that is true. Banks do keep your money safe. But that is not how they make money. Banks make money in three primary ways. The first is interest. When you take out a loan, a mortgage, a car loan, a personal loan, a credit card, the bank charges you interest on the amount you borrowed. That interest is not a service fee. It is the product. The second is fees. Monthly account fees, overdraft charges, late payment penalties, foreign transaction fees. These are not accidents or inconveniences. They are engineered revenue streams. The third, and this one surprises people, is your deposits. When you put money in a savings account, the bank takes that money and lends it out to someone else at a higher interest rate. They pay you 2%. They charge the borrower 18%. They keep the difference. This is called the net interest margin, and it is the core of how banking works. Here is why this matters to you. A bank's profitability is directly tied to how much debt its customers carry. The more debt you hold, the more profitable you are to them. You are not just a customer. You are a revenue source. And the system is designed to keep you generating revenue for as long as possible. Number 2. The minimum payment trap. Of all the tools the banking system has developed, none is more quietly devastating than the minimum payment. When you receive a credit card statement, it shows you two numbers: your full balance and the minimum payment due. The full balance might be $3,000. The minimum payment might be $65. And every month, millions of people look at that $65 and think, that's manageable. And it is manageable. That is exactly the problem. Here is what happens when you only make the minimum payment on a $3,000 credit card balance at 20% annual interest. You will make payments for over 14 years. You will pay over $5,000 in total. That is more than $2,000 in pure interest on a $3,000 debt. But this is not the most important part. The most important part is why the minimum payment is set so low. It is not set low out of generosity. It is not set low because they understand your cash flow. It is set low because a low minimum payment maximizes the amount of interest you pay over time. A higher minimum payment would clear your debt faster. That would cost the bank money. So the minimum payment is designed to keep you in the most profitable zone for the bank, paying just enough to stay current, not enough to actually escape. The minimum payment is not the floor. It is the trap door. Number 3. The interest rate game. Now let's talk about interest rates. Specifically, why the rates on debt you owe are almost always dramatically higher than the rates on money you save. Right now, the average savings account in most countries pays somewhere between 1 and 3% interest per year. The average credit card charges somewhere between 18 and 25% interest per year. That gap, 15 to 22 percentage points, is not an accident. It is the profit margin. Think about what this means in practice. If you have $5,000 in a savings account earning 2%, you earn $100 in interest over a year. If you have $5,000 in credit card debt at 20%, you pay $1,000 in interest over a year. Same amount of money, 10 times the cost. This is why carrying debt while maintaining savings is one of the most expensive financial positions you can be in. You are earning 2% on money you own while paying 20% on money you owe, and the bank is on both sides of that transaction. There is also a psychological dimension to high interest rates that most people never consider. When interest rates are high enough, debt becomes self-perpetuating. The interest you owe each month begins to approach, or in some cases exceed, the minimum payment itself, which means some of your payment doesn't even reduce the debt. It simply pays the interest that the debt has already generated. You are paying to stand still. This is not a misfortune. This is a mechanism, and it was built this way on purpose. Number 4. The psychological weapons. Banks don't just use financial mathematics to keep you in debt, they use psychology, and the psychological tools they use are more sophisticated than most people realize. The first is credit limits. When a bank increases your credit limit, it feels like a reward. It feels like they trust you, like you have been approved for more. What it actually means is that the bank has calculated you are likely to spend more and likely to carry that balance for a long time. A credit limit increase is not a vote of confidence. It is a revenue projection. The second psychological tool is rewards programs. Cashback, air miles, points. These programs are genuinely valuable to the small percentage of people who pay their balance in full every month. For everyone else, which is the majority, the rewards earned are almost always worth less than the interest paid. You earn 2% back on a purchase. You pay 20% on the balance. The reward is the bait. The third tool is convenience. Tap to pay. One-click checkout. Contactless everything. Every piece of friction removed from the payment process is a piece of friction removed from your financial awareness. When spending feels effortless, it is effortless, and effortless spending is the most profitable kind. The fourth tool, and the most powerful, is normalization. Debt has become so embedded in modern life that most people no longer question it. A car loan is normal. A mortgage is normal. A credit card balance is normal. Student debt is normal. When debt is normal, questioning it feels abnormal. And that is exactly where banks want you. The most effective cage is the one you don't know you're in. Number 5. How to escape the trap. Understanding the trap is one thing, escaping it is another. So let's talk about how to actually get out. Step 1. Stop using the weapon against yourself. If you are carrying a credit card balance, the card is actively working against your financial position every single day. Interest compounds daily on most credit card balances, which means that every day you don't pay it down, you owe slightly more than you did the day before. The first practical step is to stop adding to the balance. Not forever, just until it is cleared. Step 2. Pay more than the minimum. Every time, without exception. We talked about the avalanche method in the last video. This is where it becomes critical. Take the highest interest debt you carry, almost certainly a credit card, and pay as much as you possibly can toward it each month while making minimum payments on everything else. Every extra dollar you put toward that high-interest debt saves you multiple dollars in future interest. This is not a metaphor. It is mathematics. Step 3. Negotiate your rate. Most people do not know this is possible, but credit card interest rates are often negotiable, particularly if you have a good payment history. A single phone call to your bank asking for a lower rate has a meaningful success rate. It costs you nothing to ask, and a reduction of even a few percentage points can save you hundreds of dollars over the life of the debt. Step 4. Understand what you are actually buying. Every time you make a purchase on a credit card and carry that balance, you are not paying the price on the tag. You are paying the price on the tag plus the interest that will accumulate for however long it takes you to pay off that balance. That $200 jacket might actually cost you $260. That $800 phone might cost you $1,050. When you see it that way, a lot of purchases look very different. 4 steps. Stop adding to the debt. Pay more than the minimum. Negotiate your rate. Understand the real cost of what you buy. None of these require a higher income. All of them require awareness. Banks are not evil. They are businesses. And like every business, they exist to make money. The problem is not that banks make money. The problem is that most of us were never told exactly how they make it. Now you know. You know that interest is not a service fee. It is the product. You know that the minimum payment is not a floor. It is a trap door. You know that your credit limit increase is not a reward. It is a revenue projection. And you know that the most effective cage is the one you don't know you're in. The debt trap is real, but it is not inescapable. And knowing how it works is the first step to walking out of it. Next week, we are talking about the other side of the equation. Not how money is taken from you, but how to make it work for you. We are going to break down the 50-30-20 rule, the only budget most people will ever need. This is Capital Explained. We'll see you in the next one.